Welcome, everyone. I'm Marko, founder of TargetVest. We specialize in data and analytics for traders, helping them separate the signal from the noise. And that's exactly what we plan to do with the panel today, moving past the buzzwords to get to the data-driven insights you need. So I'm here with Haya from Plus 500, a global fintech powerhouse trading on the FTSE 250. They serve millions of customers worldwide and are known for making complex trading instruments accessible through cutting-edge technology. And secondly, Leon from Play.com. Play is the only turnkey solution helping operators launch and integrate prediction markets. They're globally available and in the US under an CFTC license. And they're purpose-built to power user management and engagement. So first question, to start off, Haya, can we talk about the state of the market? Are prediction markets becoming mainstream, or are they still a niche playground?
Thank you, Marko. So let me give you the numbers first. Kalshi alone processed nearly 24 billion in annual volume, and recently, global major platform hit $4 billion in weekly volume. So at that scale, we're not talking about a niche, in my opinion. And this platform turned that natural instinct into something tradable. So it's a probability, a simple number between 0 and 1. And why it's happening? Because as human, we ask simple questions. Will this happen? What are the odds? So that's exactly what we do at Plus 500. We integrated the prediction market alongside the future trading platform to give the traders the possibility to trade on both the cause and the effect alongside one with the other.
Okay, so you're saying the volume is there. So let's talk about the utility. If I'm trading equities and FX, and I have plenty of market exposure, how do prediction markets complement this traditional trading? You know, what gap do they fill for users?
Okay, so the gap is simple, in my opinion. Traditional market lets you isolate the event from the noise. So when you trade equity, forexes, price bundle everything together. The sentiment, the earning, positioning, liquidity. But at the end, most trading positions come down to one simple question. So take a Fed meeting, for example. Will they cut the rate? So in traditional market, you will trade on associated assets. So let's say bonds, forexes. But there is also a correlation to this. There is different time frame. So in prediction market, you can trade these events and answer this question directly. Or let's say maybe you're long on crypto, but you're worried about a blow-off top. So instead of buying or liquidating or buying downside protection, you can hedge with a simple binary contract, maybe Ethereum, about $5,000 by year end. And this is capital efficient and defined risk. And there is also a huge advantage that these markets are open 24/7. So when, for example, Trump announced the tariff on a Sunday morning, the traditional markets were closed, and you could still trade these events on prediction markets. They are always open, so you can really trade the events when the news break. And I think for the last point that there is also a real value not in the trade itself, but it's in the intelligence. So even if you don't place a trade, the probability is still telling you something. And you don't have to trade the events, but you can just look at the probabilities, look at what the market is telling, and not hedge money, but hedge accuracy of information.
Okay, great. So Leon, let's build on that. Haya just explained the value for traders. But we're also seeing a massive trend of CFD operators rushing to add this vertical. So from your point of view as an infrastructure provider, can you give us some context as to why this is happening? Is it revenue diversification, or is it a deeper shift into how operators are engaging with users?
So what we see is eventually, like in every other product, consumer is king. So the demand of the consumers wanting to trade prediction market, being part of that market that also lets them to put their money where their mouth is, what they think the market is going to happen. And for them, it's the connection from their trading experience to their whole trading experience with prediction market as part of it. So we see CFD operators looking at it, first of all, from the demand point. They are looking to bring what their customers want. After that, when you give your customers a wider solution on what you can trade and in what you can participate, that brings eventually a higher lifetime value over time for the operators, but also gives them the ability to attract new users in different points of interest. Not only about the tradable assets that the users can trade, but also predictable markets that are part of the interest of that economy. So the interest brings new users, and the trading of predictions extends the value. Both of those components bring CFD operators going full force into prediction market as part of integrated experience or as a standalone using their brand.
Okay, understood. So now that these markets are being added by CFD operators and they're becoming more mainstream and the volume's going up and all those things are happening, how do we look at the market from a trust perspective? So, if you're a serious trader, how do you trust that there's real information? How do you trust the prices? Is this just gambling, or is there a wisdom of the crowd sort of effect there?
Okay, so I think it's wisdom of the crowd, but only because there's skin in the game. So polls give you snapshots, analysts give you opinions, but prediction market gives you a live probability where people lose money if they're wrong, and that changes everything. So in a poll, being wrong costs you nothing, but in a prediction market, weak opinions get filtered out fast because traders hedge, update, and exit bad position, and that discipline gives really keeps the price efficient. So, for example, for a presidential election, prediction market beats expert forecast and polls many times and months before election day. And we see that because while polls capture a moment, a snapshot, prediction market really update in real time as money flows in. And because traders have a capital at risk, the price reflects what they really think that is going to happen. And so for traders, that probability is incredibly valuable because even if you never place a trade, if you think that an event has a 30% chance of happening, and you see in prediction market that people think it's like 70% chance of happening, you start to asking yourself, am I missing something? There is information that I don't have. And it's not about blindly following the market, but I think it's about calibrating conviction with real money on the line.
Okay. So, Leon, let's switch to the technical side. Haya mentioned the signal, how there's pricing there, how because transactions are being made, that you're attaining a situation where you're trying to figure out what the market is actually thinking, and that's valuable. So for the engine to be robust, obviously there needs to be volume and there needs to be transactions happening. So from the infrastructure standpoint, how do we support this? How do we ensure that there's liquidity, that there's stability, and that there's trust so that serious institutions and serious traders can use prediction markets to their advantage?
That's a really important question in prediction markets. And we look at prediction market in terms of how it looks, that you can predict a specific market and its outcomes, and you see the price. And it looks similar whether you're in US or outside of US. But actually, it's two separate products. The product in US is a governed, centralized product that is managed by a DCM that manages an exchange. This exchange manages like a normal stock exchange, manages the liquidity, has market makers, and connects people that want to buy and the people that want to sell. Eventually, part of that exchange, there are liquidity providers that are making the market for a wide range of sectors, not only tradable assets that you can trade on a regular market, but the sentiment, as Chaya mentioned. So those market makers are part of the vibrant activity that happens on the centralized exchange and outside of US. Outside of US, the situation is different. This is a decentralized product. It operates on a blockchain. It is not centralized by anyone, but any organization. It is actually an on-chain product that connects traders that want to trade with each other, peer-to-peer. Some of those traders might be market makers. They can bring liquidity to the market and participate in the trading as any other client in the exchange. If there is no liquidity, there is no trading happening. There is no interest. If you are seeing an event that is really interesting for you and you want to buy in and there is no one selling, there is no depth of liquidity, it makes it not a viable product. This is why market makers are a very important part. So we at Play introduced a lot of market makers coming from different sectors of the industry, not only trading, to participate in this vibrant exchange of opinions. And this is what makes eventually the trading more real in terms of the intelligence, as Chaya mentioned, in terms of the right pricing of it, but also brings the liquidity so you can buy in and sell out whenever you choose. And we see liquidity and market makers are part of the fundamental part of making decentralized and centralized exchanges work.
Okay, so it sounds like from what you're saying, everything is sort of trending in one direction. You've got more liquidity providers, more market makers coming on board. The trading and infrastructure is improving. Obviously, there's more people trading the prediction markets, which is really, really good for the industry. So given we're at the state today, at the beginning of 2026, what do we think is going to happen next? Like, Chaya, can you give us a little bit of insight on where the prediction markets are going, what they're going to become, and potentially how they're going to expand from here?
So I think that first, on the trader side, a lot of traders are getting interest in that type of trading because it's very different from the usual trading. Also, the new traders that don't have the knowledge required for specific trading, options, everything, they can really try this in an easy way. So what I think is going to happen that the major retail brokerage will integrate this alongside the traditional trading. So people could trade the regular instrument that they know, but new traders and the same traders could also trade events alongside. They can trade the cause and the effect together. So yeah, I think that it will become fully integrated, fully regulated. There is a lot of work also on the regulation side, but I think we will come to that. And it will be a real part on the trading industry alongside the traditional trading that we know today.
Okay, and Leon, what's your take? What do you think about the whole situation? Obviously, you're coming at it from a different angle. You're coming at it from a service provider where you provide a turnkey solution for anybody that wants to access in any country the prediction market. So how do you see it from that sort of B2B standpoint? Where do you see it going from here?
So first of all, I agree very much with Chaya that eventually this is product going to be part of the offering that any trading venue is going to offer. This is going to be part of the whole system of trading brokers that offer trading and offer different products. In the high level, I think in 2030, this market is going to become a multi-trillion-dollar market. We see the growth that's happening now, and we see that currently there are very small number of operators. But we as a B2B platform, we see that the operators that are going to join in with us and maybe with other solutions, but going to join that vibrant market of predictions, they are going to bring a push of marketing and exposure to this new market, and they will make that part of their trading venue experience. What would happen is eventually that end users that are managing their trading portfolio will look at their trading portfolio not only as part of the assets they manage, but they will look how they can hedge the events that are happening, how they can hedge their portfolio of stocks against things that happen just now, how they can build a strategy of long-term trading as part of concluding the prediction market strategy. So we think in the next years, strategy of traders will change. Operators will become a unified access to both prediction markets, but also CFD and stocks and other products. And this industry is going to become a driver of new interest, new customers, and new revenue for those operators.
Great. That's a really good insight. It sounds like from many angles, the market's going to grow. It's going to grow for what it is today to people using it, even potentially institutionally, it sounds like, to hedge institutional portfolios so that they can handle events that are coming up and maybe there's geopolitical risks and other types of risks. Thanks a lot for the insight, Leon. Haya as well, thank you so much for your questions, for your answers, and you provided a really good insight on how Plus 500 is also entering the prediction markets and taking steps forward to provide this great service for everybody to trade and to use.
Exactly.
Appreciate you guys being here. That concludes our session on prediction markets. Hope everybody enjoyed it.
Thank you very much.
Thank you.
Thank you.